CarMax didn't just have a bad day. Its $3.2 billion plunge didn't just wipe out stock value. It exposed the biggest, most dangerous financial lie holding up the entire used car market. In a single, brutal trading session, the company bled nearly half its value, a collapse that immediately sent shockwaves through every corner of the automotive and lending industries. This was not a minor correction or a bad quarter. This was a financial earthquake, and the real source of the panic was the confession from the top. When CEO Bill Nash stood in front of analysts, he admitted flat out he has no idea what's coming next. That admission is the real white flag, signaling a complete loss of control and a forecast of chaos for every borrower, every dealer, and every customer. When the biggest retailer in America, the one that built its empire on superior data and predictive analytics, says it can't see the road ahead, you know the crash is imminent. The pain starts not on Wall Street, but right in your driveway, thanks to a financial quicksand that's trapping millions of everyday buyers. Forget the headlines about inflation. The true danger is the grotesque cost of credit. Take that simple, practical $26,000 sedan, the kind of reliable car most families need just to function. For anyone with a credit score that's less than pristine, the interest rate at CarMax is sitting at a staggering 22.95%. This isn't a tough rate, this is a predatory trap. A nearly 23% loan on an asset that loses a third of its value the second you drive it off the lot. That one number boils down to a brutal $668 monthly payment. For the average middle-class family, that's a bill the size of a second mortgage just for a basic ride. You're forced to sign paperwork that stretches out over 6, 7, even 8 years, ensuring that by the time you make your final payment, you've paid almost double what the car was originally worth. The bank gets its money either way, but the buyer is locked underwater from the moment the key is turned. It's a vicious, exhausting cycle that keeps people chained to payments, never able to get ahead. This isn't about wanting a luxury car. It's about needing a reliable car to keep your job and being forced to accept financial ruin just to get to work. But the interest is only one piece of the debt trap. The other is the debt buyers are dragging in with them. The sticker price is merely the opening chapter of the financial nightmare. The reality is, nearly a quarter of all Americans trading in their vehicles right now are handing over keys to a car worth significantly less than they owe. We're talking about an average of $6,838 in negative equity, a monumental hole they are starting in before the New Deal even begins. This isn't a statistical blip anymore. It's a tidal wave of debt that's been building since the post-pandemic surge, making 1 out of every 4 people who walks into a dealership already massively upside down on their loan. Lenders and dealers, driven by the desire to keep sales volumes high, got dangerously comfortable rolling old debt on top of new loans, stretching payment terms to ridiculous lengths just to keep the monthly payments deceptively low. But all this practice has done is turn a simple car loan into a ticking financial time bomb for millions. Some buyers owe $10,000, $12,000, or even $15,000 more than their car is worth, and that debt is simply rolled into the new loan. This isn't a situation exclusive to people who bought luxury SUVs or high-end electric cars. It's hitting anyone who financed at sky-high prices over the last couple of years. The weight of this accumulated debt is what's now driving the next, most terrifying number that the banks are staring at right now. And what happened next would send chilling shockwaves through the entire financial sector. The banks are officially pulling the plug, creating a full-scale freeze on credit for anyone without spotless finances. In 2024, lenders seized a brutal 1.73 million cars from borrowers who fell behind, a chilling figure that represents the highest number of repossessions since the height of the Great Recession in 2009. That's a massive, sudden tightening of the screws, and the message from the institutions is loud and clear. Risk isn't welcome anymore. The impact is immediate. Approval rates for challenged buyers have fallen off a cliff. CarMax's own finance division, CarMax Auto Finance, saw this reckoning coming and is now bracing for impact. They set aside a staggering $111.7 million for loan losses in 1 quarter alone, a massive 25% jump from the year before. This isn't an accounting adjustment. It's an urgent, highly visible red flag. They are officially padding their war chest for a tidal wave of mass defaults, preparing for customers to simply walk away from their cars. The reserve creeps higher every quarter, and executive vice presidents are now publicly pointing to loans written in 2022 and 2023, when prices were absurdly high and credit was still loose, as the source of the coming losses. They know the easy money is gone, and the system built on it is starting to break under the pressure of its own debt. The repo man is not just knocking on doors, he's on a national tour, but the consequences are now cascading down to the small businesses you see on every corner. The panic has violently spilled from the stock market and the lending institutions right onto the local dealership floor, creating a dealer bloodbath that few saw coming. The most dramatic evidence is the 38% spike in dealers suddenly dumping inventory to CarMax. This isn't savvy business. It's a desperate cry for liquidity. Here's the silent killer. Floor plan interest is now eating smaller dealers alive. Every single day a car sits unsold on the lot, they owe more to the bank that financed the inventory. With retail buyers tapped out, credit freezing, and auction fees through the roof, selling to CarMax at a guaranteed loss for fast cash is often the only way to avoid defaulting on their own credit lines. This dramatic increase in dealer-sourced inventory shows the domino effect in action. One dealer after another offloading vehicles just to stay afloat, even if it means taking a massive financial hit on every single deal. The old playbook of waiting for the right buyer is useless when the market is flooded and no one can secure financing. For a lot of smaller independent dealers, selling to CarMax is simply a matter of survival, a grim signal that the market is officially in distress. Meanwhile, in this hyper-chaotic market, the perfect storm is brewing for one specific type of buyer. With banks slamming the brakes, credit freezing solid, and repossessions flooding the system, a truly unique opportunity is emerging for anyone with cash on hand. The market is violently splitting in two. On one side, loan-dependent buyers are being squeezed out by impossible rates and tightening standards. On the other side, those who don't need outside financing suddenly have massive, unprecedented leverage that dealers haven't seen in years. Dealers are desperate to move metal, clear space, and stay afloat under the crushing weight of that floor plan interest and the tightening of their own lenders. You are no longer just a shopper, you are the immediate solution to their cash flow problem. You walk in with the power to close a deal on the spot. No financing drama, no waiting for approvals. For the first time in years, the real deals, the ones where a dealer is willing to take a significant loss, are going to the people who can pay up front. This phenomenon is creating a fascinating and cruel divide. Tariffs and other pressures have pushed the average new car price to $48,000, making the used car market the only realistic option for millions. But now that option is blocked by predatory rates. The power is shifting back to the consumer, but only to the one with cash. If you can pay up front, you are instantly in the driver's seat. CarMax's massive $3.2 billion stock plunge didn't just make headlines. It acted as the final official alarm for a systemic collapse in the entire used car market. The data revealed is both clear and utterly terrifying. 1.73 million cars were seized last year, and CarMax is setting aside record amounts to deal with a guaranteed surge in loan defaults. Its CEO, Bill Nash, is essentially telling the world he can't predict the future, publicly confirming what millions of borrowers and struggling small dealers already feared. The era of easy money, sky-high prices, and even easier credit is completely over. The financial quicksand is real, and the bottom is nowhere in sight. For the average American borrower who is financially underwater, the dealer running out of options, and even for CarMax itself, the only question left is, will this crisis finally bring prices crashing back to reality and make cars affordable again, or has the debt trap simply gotten too big to be undone?